Today's guest is Charles Monchau, Chief Investment Officer of Syz Group, a Geneva-based private bank managing over 34 billion in assets. Over a 25-year career spanning Rothschild's, Deutsche Bank, and Lombard, he has built one of the most decorated track records in the industry, holding the CFA, CMT, CAIA, and CIIA designations. Today, we discuss portfolio construction, the dollar, and the AI's role in finance. Welcome to Strand Global Macro Talks, Episode 6.
So for viewers which are unfamiliar with the Syz Group and its discretionary management offering, could you walk us through the range of strategies you provide? And what do you think is the service which represents the strongest value proposition?
Yeah, so Banks is a Swiss private bank, rather young for a Swiss private bank because this year is a 30 years anniversary. Family owned by so it was created by Eric Syz, who is still the CEO of Syz Group, and his son Nicolas Syz is the head of the private bank, the CEO of the private bank. We indeed manage more than $30 billion in assets, and our core business is wealth management. So what we do is we offer two types of solutions to our product clients who are coming from all around the world. So one of them is discretionary portfolio management. So they give us a mandate to manage their assets. And here the goal is to preserve their purchasing power. So preserve the capital, but also grow the capital in order to not have their savings being eaten by inflation. And the other type of solutions is advisory. So here, we advise them how to manage their assets, and they take the final decision. So I'm running the CIO platform, which is overseeing both discretionary portfolio management and advisory. So again, we mainly manage and advise private portfolios. So we are not products manufacturers, we are not product pushers, but we do have a few type of dedicated funds, which are quite niche. So some of them are on private equities, others are on legal assets, and we also run a fund of crypto hedge funds among the kind of, let's say, products that we launch ourselves and that we're managing ourselves.
So, Charles, as a wealth manager, your main approach is to preserve the wealth of your clients. But as the changing environment, you need to take some risk to still beat the inflation for that. So, to an extent, from the change from the last decades of low rates and stable correlations, we moved into a more fragmented regime, which is more higher rates, volatility, and in a sense, less reliable diversification. So this shift, how has that changed the way you think about portfolio construction when you think about advising the clients?
Yeah, it's a very important point. We have been indeed going through what is called a regime change. So the former regime before COVID was inflation around the world is low, which means that the main risk from a macroeconomic point of view is more deflation than inflation. And this is why when you created portfolios made of bonds and equities, the good news was that bonds had a negative correlation with equities, which means that when there was a crisis, your equities bucket was going down in prices, but the bond bucket was going up in prices because bond yields were going down. So the correlation between bonds and equities was low, even negative, and it was very useful in terms of portfolio construction. Fast forward to these decades, so basically after COVID, we have now shifted into a world with higher inflation, which means that the correlation between bonds and equities is now positive. So when there is a crisis, very often the crisis leads to higher inflation expectation. That was the case with the Russia invasion of Ukraine, oil shock with the inflation shock. This was again the fear last year with tariffs, and it is again the fear this year with the war in Iran. So when inflation expectations are going up, bond yields are going up. That means that they don't protect, let's say, your portfolio against drawdown on equity side. So that means that your former 60-40 portfolios, which was made of 60% equities and 40% of bonds, for instance, is now moving into a new kind of 60-40, which is 60% equities maybe, and then 40% alternatives. Alternatives means gold, silver, commodities, but also hedge funds. and maybe private assets if clients can afford to have, let's say, longer duration products like private equity, for instance. So that means that you need to shift the way you look for diversification within multi-asset portfolios. And that means that the multi-asset portfolio of this decade is different than the multi-asset portfolio we have seen over the previous decades.
So you're using these different strategies to preserve the purchasing power. But considering you are based in Switzerland, I would assume some of your clients consider the Swiss franc as their purchasing power. So in 2025, dollar weakness reduced the returns on US equities for non-USD investors. For example, the USD Swiss franc being down 18% approximately. So how do you approach this FX risk in your portfolio construction? Do you hedge the USD exposure or treat it as rather a source of possible speculation for the returns? And has recent geopolitical events, maybe the Iran situation, changed your outlook on the dollar going forward in 2026?
Yeah, there are different questions here in the same one. So, well, you first mentioned Swiss franc. So running portfolios for Swiss franc based clients is very different than the rest of the world because the Swiss franc is a very strong currency, which means that each time you're taking risk outside of the Swiss franc, you're facing the risk of losing on the currency side. That's point number one. And point number two, we do have very low inflation in Switzerland, which means that it is less important to preserve a purchasing power by adding some risk assets because actually, because inflation is almost zero, we face less risk of loss of purchasing power in other countries. So I'm just now closing the bracket on the Swiss franc to talk about what you mentioned afterwards in your question, which is the risk of depreciating currency. Look, even for Swiss franc based clients, when you invest into US equities, you know that you might lose on the currency side, but what is lost on the currency side might be more than offset in terms of price appreciation. I'm going to take a very simple example. At the start of the century, um, in 2000, the Swiss franc against dollar was a 180, 1.8. Today is less than 0.9. So you can see there is more than 50% depreciation on the dollar. But if you had invested into dollar-based real estate in the US, for instance, if you invest into the S&P 500 or in NASDAQ, I can tell you that the price appreciation is much higher than what you will have lost on the currency side. That's point number one. Point number two, there is a big interest rate differential between the dollar and the Swiss franc, which means that if you want to hedge, it's going to be quite costly. So the cost of your hedge might just destroy what you're gonna, let's say, gain in terms of avoiding any currency depreciation. So what we used to do, at least on the equity side, because we don't want to take currency risk that much on the fixed income side, but on the equity side, when we invest into US equities, usually we hedge very little because also the depreciation of the dollar means that the exporters, the US export companies, are going to probably make a lot of money because if the dollar depreciates, they're going to be able to, well, let's say, sell even more in terms of volume. So the depreciation of the dollar is usually a help for them. So we don't hedge that much. We take the currency risk because we invest into US assets, US dollar-based assets, and these assets might actually do much better than the currency depreciation. You also ask into your question, what about the effect of war? Yeah, it was interesting because, as it is often the case, when there is a geopolitical shock, suddenly the world is looking for dollars, and the dollars become scarcer, and the dollar appreciate. This was the case again this time. The appreciation was not that very spectacular. It was a very little appreciation, but still, at least the dollar didn't depreciate as it was the case last year. But we think this is just temporary. Our view on the dollar against the Swiss franc, against the euro, is that the dollar will continue to depreciate in the coming years. Why is that? Because they have very high budget deficits. They have rising debts. The Trump administration does want to see a weaker dollar. So we think that the dollar will continue to depreciate against other currencies, at least against the euro and against the Swiss franc, obviously.
Okay. And Hugo will continue with questions.
So you've historically written very positive things about AI. You argued that it wouldn't be a fad, and given relatively very high valuation multiples and heavy CapEx spending by some of these hyperscalers, a lot of value-focused investors are very scared of having exposure towards it. Do you think that this current AI boom and huge Mag 7 gain parallels to the dot-com bubble, or do you think this is going to be a generic misallocation of capital? And how are you rotating exposure for Syz Group discretionary management strategies?
I think that's the AI, Gen AI secular growth story is something we have never seen before. It's extremely powerful. It's definitely a tech revolution. I also believe that we are in the early stage. You wanted to compare it to the dot-com bubble. I went through the dot-com bubble. I can tell you the big differences between this AI story for the time being compared to the dot-com bubble. Dot-com bubble, there were many IPOs every day. There were many ways to play dot-com. And this indeed created, let's say, a crowded effect, which is too much supply coming to play one theme. Whereas so far, the way to play AI has been just investing into a few stocks. So that's the big difference. In the 2000s, a lot of IPOs, any companies with, let's say, .com behind it was able to raise capital, and that created, let's say, afterwards a crash. By the way, many of these .com companies were not making money. And then these days, the Mag 7, there are a few stocks to play AI, and on top of that, they are making a lot of money. That being said, we think we are moving into the 2.0 phase of AI. There will be winners and losers. We think that when you invest money into equities, you need to each time ask yourself, am I on the right side of the fence? Am I with the winners instead of being with the losers? So who are the winners? First, pick and shovels. So we are still in the AI infrastructure build-out of this tech revolution. So you still need to invest into the right infrastructure. How you play infrastructure, semiconductors, they are skyrocketing currently. Some hyperscalers, but also some new players coming in. So you still need to look at infrastructure, and there are still some winners on the infrastructure side. Point number one. Point number two, the companies which are able to use AI at their own benefits to improve their profitability. And here you might find them in other places than tech or the US. Could be finance, it could be healthcare, it could be consumer discretionary, and that's the good news. And this is why, by the way, if you look at the current bull markets, the market advance is broadening. It's not just the US. Asia is doing well, emerging market is doing well, even some European stocks are doing well. That's a change, okay? Third type of winners of AI is called the halo effects. High assets intensity, low obsolescence. Think about the businesses that cannot be disrupted by AI. So here, think about the oil economy stocks. And currently, investors are paying a premium for these stocks because they know that they are less at risk of being disrupted by AI than oil stories. So these are the three type of winners. What about the losers? Infrastructure, which are spending too much. During the dot-com, the losers were the companies which overinvested into fiber optics. Fiber optics suddenly went through a deflationary crash, and those who overspent to fiber optics were not able to generate enough return on investment capital, and the stock price collapsed. So be very careful with this one. What if OpenAI is not as profitable as many anticipate? A lot of money has been invested. A lot of money has been invested even by other companies. If OpenAI is not as successful as anticipated, it will be a disaster for the OpenAI ecosystem. So that's one kind of loser. Other type of loser, companies which are being disrupted heavily by AI. Think about some software stocks. You probably saw software stocks, many of them collapsed because AI is eating into their plates. So just to summarize, when you think about AI, it's a long-term secular trends, but there will be winners, there will be losers, and be very careful on which side of the fence you are.
Yeah, bringing back to your second point, I think everyone somewhat agrees that the safest bet to how we can benefit from AI in terms of equity investment is getting the recipients of all this AI infrastructure into common businesses, such as financials, for instance.
Yep.
But a lot of value investors are trying to do that. But the problem is that it's not always obvious when a company actually says they're using AI or they're actually getting productivity gains. There's an article that came out that said the chief economist at Goldman Sachs recently said that AI contribution to US GDP growth in 2025 was basically zero outside of CapEx. Well, it's a Morningstar company that reported this. But the other attention I want to point you to is there's an article by the Financial Times which said information processing and equipment and software were only 4% of GDP, but accounted for 92% of GDP growth in the first half of 2025. So on one side, we're seeing that, there's been huge productivity gains, mostly on, call centers and software, but not to have a whole aggregate GDP increase. And at the same time, most GDP increase in the US is being driven by CapEx. This gap between CapEx spending and productivity gains from AI, how do you think it's going to play out?
I think it's probably already starting to pay out. And by the way, you mentioned financial industry. I don't know if you know what is the IT budget of JP Morgan. It's actually 10 billion.
Yeah, huge.
And AI is 1 billion. So I don't think they are investing $1 billion for nothing. They are very cognizant of their profitability. I'm going to share also with you a few numbers. If you look at the number of employees of the S&P 500 between 2016 and 2025, they grew in aggregate by 3 million people. So look at the S&P 500, a big company, 3 million people hired between 2016 and 2025. And then what happened in 2025? For the first time in 9 years, the number of aggregate employees for the S&P 500 went down by 400,000. Why is that? Because companies are replacing labor by AI. They also want to invest more into IT than in people, and they are starting to get the benefits of this investment in terms of productivity. So here there is a change in trend in terms of hiring, at least for the time being, because I tend to believe that any tech revolution initially destroys jobs, but then afterwards creates a huge number of jobs. It's always been the case, and it could be the case again at this time. But other numbers is that if you look at the net margins of the S&P 500, it keeps moving higher. This year, the consensus is expecting margins for the S&P 500 to keep growing from 13.2% in the fourth quarter of 2025 to 14.6% at the end of this year. So you can see, very important margin expansion, and this is coming from AI. So I don't believe in this, let's say, theory that we'll not see any productivity gain. I think we're going to see huge productivity gain. I can tell you on my side, I'm running a CIO platform. Financial research is the backbone of what we do. I can tell you guys, what you can do after 2 or 4 weeks at my place compared to my generation, where it took us years to educate a financial analyst. You guys are ready in 2 weeks. I created what is called a Syz Research Lab, which is a research unit only made of graduates and interns. And the productivity of this entity is second to none. They are using AI very extensively. They are able to code to improve my process, the systems that we are using. They can write, they can dig into stock research, into credit research, into macroeconomic research. the productivity gains are just massive. So I believe that the let's say the productivity gains of AI are going to be massive, including in the financial industry.
So, Charles, that's really interesting, the approach you're using in the company. So, this financial research departments, for example, that you set up, with your philosophy also, to what extent is the research they're doing is on the top-down side, which is like macro rates and liquidity, versus more of like a bottom-up opportunities with like specific equities or a more specific approach? And for example, if they have a conflict, how do you resolve these conflicts between if two of those aspects tell a different story for the outcome?
It's a fantastic question and very let's say timely. I'm gonna take a very, let's say, simple example, which is what we have seen over the last few weeks. So last few weeks, there is this Iran war. The Strait of Hormuz is closed. We are facing a massive issue in terms of oil shortage, refinery shortage, and on the macro side, you know, the macro research is telling us, flashing red, saying, look, this looks like inflationary shock. This is going to dent GDP growth. This is going to push inflation expectations upwards. We're going to see some massive issues in terms of supply chain. And also that means that central banks will be in the corner and they will not be able to cut rates. So that's macro. The macro message is quite negative, okay? Then we have another pillar, which is the bottom-up pillar. What are the companies telling us? The companies, we started the first quarter earnings season. CEOs of banks are telling us the U.S. consumer is resilient. The U.S. businesses are spending. We don't see any issues in terms of private credit stress. Things are okay. And by the way, we are not taking down our earnings estimate for this year. On the contrary, we think that earnings growth is going to be higher than expected. So here, the bottom up message is much more positive than the macro message. And then last message is, what is the market telling us? The market is telling us everything is fine. Credit spreads are tightening. The long-term trends of equity market is still up. Market breadth is okay. Cyclicals are outperforming defensives. Dr. Copper, the copper price is moving up. So here, if we put all of this together, the message is, yes, the macro top-down view is cautious, but the rest is telling us that we need to stay invested. So this is the way we reconcile things. I do have a very holistic approach to financial markets. I studied fundamental research. This is why I did the CFA. I did some macroeconomic at schools. That's for the top down, but I also studied CMT, Charter Market Technician, because here, you understand that people spend too much time trying to guess how the market should behave instead of listening to what is the market telling us. And very often, the market is right and is giving us a message, and we need to listen to what the market is telling us. So here, my approach is to try to reconcile these different type of information and have this holistic approach to investing.
Great. Thank you so much. Closing remarks. I will just say that I am personally very bullish on AI myself. I think I'm just trying to ask the hard questions on CapEx spending, which is the hardest part. Thank you so much for attending. This was episode 6 of the Strand Global Macro Talks. Like and subscribe, and we'll be posting an episode every week. Thank you so much, Charles.
Thank you so much,
Thanks.
guys. All the best. Best of luck. Thank you.